Welcome to Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX and KWBY, and again on Saturday morning at 9 on KATX and KWBY as Angela Robinson joins Terry Slavens to share important financial information to help you live life on purpose. Insurance, investments, estate and tax planning, and much more. All covered now on Life Planning 101.
Welcome in Life Planning 101 right here on KATX KWBY on a beautiful Monday morning. And we have Angela Kennedy Robinson in with us, and she has a special guest as we do every month.
Yes, that's right. And it's a very special guest this month because it may be a beautiful Monday morning, but we all know what's been going on in the markets, and it ain't been so beautiful, so to speak. And so it's been a rough ride over the last several weeks, and especially last week. And, you know, it's really interesting. So we definitely wanted to get our in-house CFA in here to speak on this. And, you know, I think the question on everybody's mind is, should I be worried about the market? Should I be worried about my money, right? And I think the funny thing is, and we can say this about a lot of things, but it depends. But not on what you think it depends on. You know, most people think, well, it depends on if I'm nearing retirement, I need to get more conservative. Or if I'm already in retirement and I'm taking income, I'm worried about running out of money. Or I'm, you know, building my retirement and I can't go through another 2008 again if I want to retire, right? And everybody's got these questions in their head as they're seeing all this volatility because it's big. We're having lots of big numbers. We're not used to these big numbers because the market's never been this high. So is it really what it appears to be or not? And believe it or not, it doesn't depend if whether you should be worried or not on any of these things unless you're letting it. So, you know, I think you go back to, you know, we've heard this on the show so many times is, you know, what the average investor makes versus the actual S&P 500. And so I tried to look for the longest period of time that I could find. And there was one ending December 31st, 2013. And the S&P had averaged for over 30 years, 11.11%.
Wow.
The average investor, equity investor, made 3.69%. Wow. Yeah. So why is this, right? And we've talked about this on show after show. There's a lot of, it's such a phenomenon that there's actually a study behind it called investor psychology. And it shows repeatedly that our emotions keep getting in the way. If you think about all those things I brought up, should I be worried about it? The question itself is out of fear. Right? All of these things about not having enough money, approaching retirement, you know, making sure that I have income, right? They're all out of fear. So is that the real reasons that you should or shouldn't be worried about the market? Is that the economical reasons, the numbers, the, you know, what's going on with the actual markets themselves? Well, obviously it isn't, right? So we're going to get to the meat and potatoes because I think this is what everybody wants to know is what the heck is going on? Why is it like this? And the elephant in the room is, are we headed towards another recession? Is our run over? Because it's been since 2008. Here we are 10 years in. What does things look like? And so I'm so happy to have Aaron in here today to talk about something that we kind of look at when we're looking at recessions. And sometimes, you know, the thing is you got to remember is there is no crystal ball. No matter who tells you that they timed 2008, they will never time something again in their life. That was a once in a lifetime phenomenon thing. It won't happen. Economists will tell you that all the time. We only get one chance to be right in our lifetime. We just hope it's over the biggest one, right? So there's a lot of truth to that. But, you know, I do think that there's some things that you can definitely be looking at to help you stay objective, to keep you educated. And that's what we have here, Aaron in here for today, is really to talk to us about what are these things, you know, that not necessarily are a crystal ball, but what can investors be looking at to know whether or not they should be worried about what's going on right now?
Good morning, everybody. That's quite an introduction and way to step into this. But, you know, one thing I like to try to talk about is that there is definitely a difference between a recession and just the market doing what the market's doing. And right now the market's just going up and down. If we look at the economy, because that's the most important part. Think about this. It's very hard for companies to do bad when the economy is doing well. If consumers are buying and selling goods, we're creating new things, we're building new buildings, someone's making money off of that. And regardless of what the stock market's doing today, it's going to pay off in the long run. So when we're looking at the stock market, this on a day-to-day basis, all this is emotions. 90% of the trading is people either buying or selling stocks, and almost all of it is emotional. It has no background. So when we look on the long run, we want to see what the economy is doing, because we want consumers to be buying. We want companies to be growing, even if their stock prices are not. So we can look at the economy several different ways. One, we look at the leading economic indicators, and these are what is happening in the future. If companies are buying inventory right now, or we're building permits to build new real estate, we know things are going to be happening in the future. So it's a good way to see where the economy is heading. And these LEIs or leading economic indicators have predicted when the economy turns. And that's really what we want to be looking at when we are investing, not so much what the stock market is doing on a day-to-day basis, because that is scary, especially this month. We're not used to normal volatility. And this is pretty normal, up until about 3 years ago, the market on average was up 15% or down 15%. And when it gets bad, it gets up to around 20%.
Right. And I heard a stat on Friday about GDP, and they said if we continue on the track that we're on today, we'll be outpacing anything that we've seen for over 10 years.
Yeah, it's crazy. GDP right now has increased 3.5% for the third quarter. That was way more than expected. And guess what? Personal consumption, way up. It was up 4%. It's nothing we even dreamed of. We never even thought it was that high. So if people are buying more goods, shouldn't that translate into better results from companies regardless of what the stocks are doing? Stocks are emotional right now. It's not a good time to be trying to guess what's going to happen tomorrow.
So when we come back, what we're going to talk about is when you actually should be worried about the market under current circumstances. You don't want to miss it right here on Life Planning 101 with our very own CFA, Aaron Kennedy. Should I be worried about the market? Isn't that the question of everybody's head at the moment when we're seeing all this crazy volatility, opening with the futures all over the place? We hadn't seen, this kind of volatility in years. 2013, I guess, was the last time that it got crazy. So the biggest question is we just came back, and Aaron Kennedy is with us, our very own CFA, doing a great job talking about what we actually look like that's a non-emotional factor. But even if we didn't have these economic indicators to look at, I think, and let's pretend that we didn't for a second, should we be worried about the market? Should investors be worried about the market in general?
All right. So when we look at the market, Angela said earlier, during that time frame, the market was up 11% and the average investor made somewhere around 3.5%. Ouch. We have to remember what we're doing when we're investing. When we're investing, we are getting paid to take risk. Paid to take risk. So if you think of it that way, we know the market's going to go up and the market's going to go down. We do not get paid to invest to make returns. Think about it. We do not get paid to make returns. We get paid to take risk. So if you look at it from that standpoint, there's nothing wrong with going down. If it goes down, then that's what we're getting paid for. If it never goes down, you're not going to get paid 11%. So if you look at the market that it's normal for this to happen, should we be worried today? And if we go back to the economics, GDP is actually growing. Our economic indicators are very positive. They're up 0.5% for the month. I look at another one from the Chicago Fed that shows where we are right now, and over a rolling 3 month and a rolling 1 month, we're still good. We're still growing above trend. And all these numbers are trend. This is what we grow on average. We're doing better. So in the short run, the stock market giving us a great deal. I like that.
Yeah, that's right. And I think one of the things is investors, I think, most likely what we're saying is should have a fear of themselves in this environment. That's what you should worry about, is your own emotions taking over your portfolio. Hijacking your returns, right? I look back, you think about the most successful people. Warren Buffett, right? We know he's the greatest investor of all time. He says, buy fear, sell greed, right? But you look outside of investments and you see people like Michael Jordan, Jerry Rice, you think about all these greats, right, that are out there. And what do they all have in common? Discipline.
Right.
Discipline. To be successful in anything, you had to have discipline. You got to have a plan in place, a goal that you're working toward. And how can we do that and, set that up? And I know, Aaron, that's something you focus on for all of the Smart Money Group and Kennedy Financial Services clients, is giving them a discipline that they can follow. So can you speak to a little bit about what that kind of looks like?
Regardless of what's going on in the market, there's things that we always want to keep in the back of our heads. Number one, as a human, we're going to make the wrong decision. Do you know how powerful that is when you lead any decision with that? Just think about that.
Just go the reverse.
Yeah, that's almost exactly right. Is the market down right now? Yeah. Are you scared? Yeah. Should you sell everything and run? Ooh, that's probably not what I want to be doing. So I look at things from a different standpoint. I think I've said this before. I have buy lists of things I want to buy when a stock gets down to a certain price. That's powerful.
Because you're emotional too. Just like
I'm emotional
else.
Too. But I want to turn that on my head because, I think every decision I make is going to be wrong.
Right.
I'm supposed to be surviving. God made me this way to stay in the cave and keep warm around the fire,
right.
Not to go out and fight saber-toothed tigers.
Yeah, that's right. So in other words, what you're telling me is we need to get you off this radio show and back behind the computer trading. Buying, right?
Yeah. And if you can look at the market as an opportunity when things are bad, this is what Buffett alludes to. At what price does this make this investment an amazing investment? And when prices go down on great companies, you get those opportunities. And right now, it looks like we're getting some great opportunities. And it's been that way all year long. We've had wonderful companies just getting beat up in things we use every day. Procter & Gamble, Colgate, all these wonderful companies that are just getting hammered just because... I don't know. That's the wonderful companies. I'm still washing my hair.
Amazon,
I'm still brushing my teeth.
I still order off Amazon, so yeah. I don't know.
Amazon's gone from north of 2,000 down, it was at 1,600, and right now I don't know.
That's not a recommendation to buy them.
No,
Can't
it's
say
not,
that on the radio show.
Not a recommendation to buy, but... at some price, that gets to be a very attractive investment. And if we can look at things from that way and, look at, hey, I've made plenty of money on this investment, so I'm going to sell high to buy this other great company that's on sale.
That makes perfect sense.
Yes. And there's lots of ways we can do that.
Right.
And we do that through our process, and it's automatic.
Right. So when we come back, we're going to be talking a little more you don't want to miss on should you be worried about the market. All right, back on life planning. Should you be worried about the market? And, back in 2000, our company actually created an investment process. It tells you it's been in place for 18 years. And, our experiences over those 18 years has taught us to be comfortable with our disciplines. And this whole show is about having discipline with your investments. If you don't have discipline, if you don't have a discipline process in place, a plan in place, yeah, you should be worried. There's no doubt. But if you do, you you just need to stick to those disciplines. It's not to say that things don't need to be adjusted or amended, or, life happens, right? The world changes, your picture changes, the future changes. So you have to be proactive, not reactive. But you also have to have something Aaron said at the last break, systematic in place to let it override your emotions when your emotions are getting the best of you. So, one of the things that we talk about is core values of our process, and education is huge to us. That's why we do this show. We have tons of families that are clients of ours that listen to this, and we'll be listening to this today. And we believe in that education. It's very powerful. The other thing is getting your risk right. We have a question we ask all of our clients is, are you sleeping at night? Something keeping you awake at night. And if something's, we call this a sleep test. If someone's keeping you awake at night, then we need to address it. And that includes the volatility in your portfolio. Because no matter what your goals are, if you can't be comfortable with the swings that are going to happen, right? We've been preparing everybody for years over what is going on, but still nobody has ever prepared for it. Right. So we've got to be prepared for that. And then, at the end of the day, like we said, systematically. But there's one more thing we want Aaron to talk on today, which is huge because people forget this. They say, I want a diversified portfolio. What does that mean? Does that mean I have diversified investments? Well, in our opinion, yes. Tax, yes. But also, are you diversifying your risk, not just your investments?
Yes, that is something we watch very closely, because if you only own the stock market, let's say you only own the S&P 500 or you only own the Dow Jones, there's certain risks that you're taking, and those are the only risks you're taking. And that's the only source of returns you're going to make. So when we go through a rough spot in the market and everything is going down, guess what? You are going down. There is no buffer. There is nothing to sell out of. There's nothing that we can sell high and buy low when everything is going down at the same time. And there's lots of other things that we can invest in and take different kinds of risk. What if we thought about currencies? You can make money on currencies, and you can diversify your risk going that route. Interest rates, investing in different governments around the world. There's lots of different things that you can invest in.
Hard assets. And the goal is to have something working when nothing else is, and importantly, to have something not working when something else is. It's funny you say that. When we show a client their review on an annual basis, I always go through all the investments, which there's a ton of them, go through all the investments, and I say, if everything is positive on this line, we have a problem. We want to see something not working because we have to have an area to buy.
Yeah, that's exactly right. If everything you have is going up, everything you have will go down too. It's rule of thumb. So you need to construct your portfolio to have some kind of positivity in it regardless of what's going on. Are interest rates going up? Well, how do we make money on that? If interest rates are going down, how do we make money on that? And we have to have an idea in our head what we can make in the market, and we can't exaggerate that in my mind. We can't say, I've been making 18, so I'm going to make 18 the rest of my life. No. The market average is 10. So let's be realistic with our returns. Let's not, try to make as much as we possibly can. Let's not try to take as much risk as we can. Let's get realistic with what's going to happen and adjust our portfolio risk-wise where we can still stomach the downturn and then get every bit of that upside that you're deserved.
Right. That's big, and I think there's a good quote that sums all this up I found. It's from Wayne Dyer. He says, you cannot always control what goes on the outside, but you can control what goes on in the inside. And I think the thing to remember is we're always going to live in interesting times. there's never, history will repeat itself to a certain extent, but It's always going to be interesting. And, that makes sticking to your disciplines that much more important because nobody has that crystal ball. And just remember, what decisions you make today may impact the rest of your life. So how long is that going to be? We've got a great article on this. Make sure you go to www.kennedy-financial.com. There's some other resources about investor reality and what's going on in the markets. It's a great week to be on our newsletter, and make sure that you pay attention to that. So please subscribe. Again, we want to thank everyone on behalf of Aaron Kennedy and myself, Angela Robinson with Kennedy Financial Services and Smart Money Group. And we just appreciate our listeners every week. God bless you.
Thank you for joining us for Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX and KWBY, and again on Saturday morning at 9 o'clock on KATX and KWBY for more Life Planning 101.
Advisory services offered through Smart Money Group, LLC, a registered investment advisor. Securities offered through Calton & Associates Incorporated, member FINRA SIPC. Kennedy Financial Services Incorporated is an independent of Calton & Associates Incorporated and Smart Money Group, LLC.